Hello, everyone, and welcome to episode 6 of Choosing the Right Location. Um, so, the question I get and have gotten recently is, where do I begin investing in real estate? What location? What is the best place? And that is very different based on person to person and especially your investment goals. So, my first piece of advice is determine what your goal is. And I believe it's episode 2, Determining Your Real Estate Goals, where I talk about how to determine your real estate goals. Um, it's important to figure out what that goal is because that'll help steer you in the right direction. So, where do I invest? Let's talk about if your goal is, for example, fix and flipping. So, fix and flippers are, let's say, somebody that wants to replace their current job with that 40-hour work week. So, fix and flipping is a earned income kind of job, unless you can scale it where, it's automated. But for the early, stages of that, let's say I want to invest all my time, that 40 hours plus per week, into finding properties, fix and flipping, and receiving an income for that. I can do 5, 6 flips a year, depending on how much cash you have. Even if you use other people's money, maybe you can do more. So where do you invest for fix and flip? I think that would determine um, if you do that option. So if I want to fix and flip, I have to determine what is a market where it's worth my time. So for example, if you're making $100,000 a year or $80,000 a year, you want to be able to fix and flip to replace that. But if you're in a location where you're trying to fix and flip 5 properties a year, but you can only do 10 per year, make 10 grand per flip, you're only going to make 50 grand. It's not going to replace that 80 or 100,000. So I think what question you have to ask is, if fix and flip is the investment strategy for you, is how much money do you need to make per flip, and how many flips do you need to do per year in order to replace your current income? So this would set you on markets where you're going to want to search and figure out how many days is the average home on the market for. So if I invest in a property and I go and I ask a real estate agent, or I get access to the MLS, or I look on Zillow or realtor.com, and I go into a market and I look at all these properties. This property's been on the market for 30 days. This property's been on the market for 60 days. This property's been on the market for 90 days. If I'm investing in property that has been on the market for 30 plus days, that is not moving quick. If it takes me around 45 days to perform a flip, or even 60 days to perform a full flip, and then it takes me another 30 to sell it, that's a 90-day window that my money is tied up and my cash is being used. That minimizes my ability to perform that again and again, which means I'll only be able to do 4 flips a year. So you should really look at that, because that means the demand of that location isn't as high as you'd like it to be. You want to sell that property as quick as possible, because that recoups your cash, and then you can plant that cash into another property as quick as possible. And so if your market is having trouble selling homes, it could also be based on the real estate agent. But if your market is having trouble selling homes, I would strongly encourage you to find markets where the days on market, the DOM, is very low. I'm talking 10 to 30 days maximum, where your property can be listed and sold very quickly. And I'm sure that there are some higher level fix and flippers out there that would recommend maximum 15 days, because that's the whole underlying reason you would perform a fix and flip, is because you want to make your cash snowball as fast as possible. And if it's tied up for 60 plus days, 90 plus, 120 plus days, that's not really the return you're looking for. And so the demand wouldn't be as high in those markets. Now, you want to find markets where there's extremely strong population, it's very populous. You're looking for markets that have strong jobs. This would be like the DC, Maryland, Virginia area, or the DMV, where you'd have plenty of government jobs, defense contractors, Silicon Valley or LA, where there's tech companies that have their headquarters located there, or major cities where other companies have their headquarters, like Tesla I don't know exactly where Tesla's headquarters are. I believe it's now somewhere in Texas, but in locations like that, it'll allow you to have steady, strong rental demand. It'll allow you to have, or sorry, specifically for fix and flip, it'll allow you to have steady and strong buying pool, where those buyers are going to, offer on your home extremely quickly. So that way you can turn around and get your cash back from that fix and flip. So, again, what market do you want to be in? I highly recommend you look for low days on market, extremely strong job, steadiness in jobs, and then a very populous city or community, in that DC, Maryland, Virginia area, where the average city's got 40,000 people in the suburbs, is extremely high. Whereas a suburb of, another major city may only be 10,000 to 15,000. It just depends on the location. So you also want to have high enough margins where, for example, here in Maryland, we could find a property for anywhere between $100,000 to $150,000 if it's distressed, or if you, do your due diligence and you find a distressed buyer. Getting your hands on a property for $100,000 to $150,000, putting $40,000 to $50,000 into the property, you could turn around and sell that property for $300,000 to $400,000, because the demand is extremely high, the cost of living is extremely high, and those 3-bed, 2-bath homes around this area are going for $400,000+. So, and that's single family homes, townhomes. So I highly recommend looking for locations like that. So what type of locations if you're a buy and hold? So someone that's not really interested in fix and flipping, the risk is higher there. Let's say I'm just an investor that wants to buy and hold. What type of market am I looking for? Well, you're looking for locations where properties cash flow extremely well. So me personally, I follow that 1% rule, which many investors follow. The 1% rule applies for if you have financing. So if I buy a property for $200,000, it needs to rent for at least $2,000 a month in order for me to make any money. Otherwise, I'm probably going to have negative cash flow. And so you want to buy in locations that cash flow well and that have appreciation potential. So if I buy a property that's located in a rural town with 4,000 to 5,000, 6,000 people, it may cash flow very well. It is very possible I can find a $100,000 property in some rural town that'll rent for $1,200. So it by far passes the 1% rule. So it's good cash flow, but it may not appreciate at the rate because there's not really a huge influx of people trying to move to those locations. And so you may have trouble trying to find appreciation value there. If you buy it for 100, 3 years may go by, it may be worth 120, 130. But if you bought that same $100,000 property in one of those suburbs of a major city, like I was saying earlier, you may end up turning around and selling that for $200,000 to $300,000 a few years later. And if COVID was any indication of that, it's very possible. So I would look for properties that cash flow very well. Look for locations where that 1% rule is met or far exceeded. In this market, I have found that multifamily properties have done extremely well during this time. And that goes for rural locations. It goes for suburban locations, where you can find a property for, $200,000 or less, and each unit would be rented for minimum $1,200 to $1,300. So it far exceeds that 1% rule. It allows you to go get financing. It allows you to use debt to where you can cash flow at a high rate, even if the interest rates are not so good. So what about if you wanted to do the BRRRR strategy, where you buy a distressed property, you fix and flip it, and then you're looking to refinance or cash out? Well, you're going to want to buy places that are cheap and distressed. So you need to find a market where properties are not really like high, A-class neighborhoods where there's hardly ever a distressed property. Um, you're going to look for those type of markets that have tons of value add potential, where you can find that distressed property. There's tons of equity or sweat equity to be made, and then you can turn around and that property, when you get your cash out in that refinance, you can cash flow that property very well using that 1% rule or exceeding it. And and again, today's bad rates, multifamily has proven to be an extremely powerful strategy, using multifamily, whether duplex, triplex, or quadplexes, to find some of those distressed properties and then rehabbing them and then refinancing your cash out. What I've found is there's many people that understand real estate is a good investment. They don't really know how to go about it. And so you find a lot of owner operated multifamily properties that they manage themselves. And here we are years later, and the property gets a little distressed because it gets too much for the single investor to handle. They don't really know what they're doing. And so you can go to them and offer them kind of like a buyout, like, hey, I'll buy out your position. And they walk away, clean with some cash in their pocket. Now you take ownership, you rehab the property, refinance it, everything gets fully rented. And now you've made that sweat equity because it's a win-win for everybody. You've bought out the original owner, and then you've now taken over, and they can walk away scot-free without really any damage being done to them. And then you get the benefit of having that knowledge to be able to turn around and, cash out and profit that money. And now you have a cash flowing property, even with a 7% interest rate. It's possible, if you have a 7% interest rate on a property that costs you $150,000, but you have 2 to 3 units being rented each at $800 a month, you're going to cash flow very well from that. So what about if you're wholesaling properties? What kind of market do you want to be in? Wholesale is interesting because you're going to want to find places that are distressed, or that have a suitable pool of investors that you can assign the contract to. Now, wholesaling is very similar to being a real estate agent, where you're going to want to have a very strong network of people. And if you don't have it, meeting people or getting to know people, Facebook groups, Craigslist, that's a great way to get started. You're going to want to find properties where there's a large investment pool that are looking to invest into a buy and hold or a fix and flip opportunity. That way, when you go under contract for that property, you can assign that to those investors. But you can't do that if there's a rural town with 4,000 to 5,000 people and nobody wants to invest there. Who are you going to assign the contract to? So if wholesaling is your strategy, there's nothing wrong with that. And you can wholesale properties all over the country. But I would strongly advise you that if you're new to it, or you want to get started in a off-site location, I recommend that you have some sort of insight where there is a strong investor pool, getting to know some real estate agents, where you can then talk to those agents to say, hey, do you have a buyer for this? Do you have a buyer for that? You can assign those contracts and then get your commission, then you're out. So keep that in mind. Then there's another strategy called subject to, and without going into too much detail, this is where you as the investor would take over the loan payment of the seller. Usually this is going to be, again, another distressed seller or a distressed property situation where the seller is financially in trouble. They need some cash. Maybe they're going into pre-foreclosure. They're about to be foreclosed on. They can't afford their payment. You can find these anywhere in the country. You can find these on $2 million properties. You can find these on $50,000 properties. But you're finding a distressed seller. You're going to take over their loan payment. The loan remains in the name of the seller. You as the buyer then transfer the deed, or the seller transfers the deed to the buyer. You give them some sort of down payment or cash out. You give them some sort of, here's $5,000, $10,000 for the property. You pay closing costs. Maybe there was a realtor involved. You pay realtor fees. Now you own the property. They keep the debt, and then you manage it to the best of your ability. So if that's your goal, you're going to want to find a property that cash flows well. I'd recommend you're also looking for that appreciation value. So yes, you could do this in a 4,000, population rural town, but I highly recommend that if that is your goal, you're looking for appreciation value as well. That way, if something does go wrong along the way, you can cash out that appreciation because you own that property. But if the property doesn't appreciate, you're just looking for the benefit of that cash flow. And like anything, if the water heater goes out, if something happens, it may take 2-3 months cash flow that eats away at your investment. So keep that in mind. And then there's commercial real estate. So where would you invest in commercial real estate? Well, you're looking for markets where the again, it also depends on it depends on what your goals are. So personally, let's say I want to own high value commercial real estate. So I want to look for a commercial property where cap rates are trading at a low interest or a low cap rate, where it's a 4 to 5% cap rate. That means the property's trading at a much higher value. And then I'm looking for distressed properties, properties with high amounts of value add potential. So if I find a distressed property in a high value add potential area where those properties are trading at 4 to 5%, well, for every dollar I put in, I'm making, 25 on top of that. So that's where the value add potential really like tremendously increases. So if I'm buying at a 10% cap rate, every dollar I put in, I'm only making 10. It's not really going to snowball me the way I want. This will lead you to faster growing returns and a stronger tenant base. So if I invest in a $200,000, 3,000 square foot facility in a town full of 4,000, 5,000 people, then what happens if I don't find a renter? I have to find a commercial tenant to rent that space. What happens if I can't find them? Now you're stuck with a commercial property where you're owing on a $200,000 mortgage. But in a rural town with 40,000 people or a city with millions of people, I find a distressed property, even by holding it. All the time, cities are trying to turn around lower income areas or more rundown or distressed areas. Cities are offering tax benefits, they're opportunity zones, they're offering investors deals to come in and turn around a property. There's much more opportunity for that in high population areas because there's tons of people there. The cities want those places to be used. They want people to benefit and move to their city. Excuse me. So it makes everybody more money. So I want to buy in an area where I can find a distressed property. With a high cap rate or low cap rate, which turns into a much higher value property. I can turn around and do a cash out refinance once everything gets rented and, snowball that money extremely quick to be able to go plug it in and do something else with it and maybe even change my strategy once that's been done. So that would determine exactly where I'm trying to, where I'm trying to invest. So I hope that answers a lot of your questions about where I need to invest. So personally, to explain my journey, I wanted high cash flow. That's what my goal is. My goal is cash flow. Appreciation is a secondary goal. So when I buy properties, my objective is I want to plug my cash in, whether it be the BRRRR method, where my return on investment is going to be extremely high, or whether it just be a buy and hold. I want to plug my cash and receive at least a 25% return, cash on cash return, and I'm going for cash flow. So if my property never appreciates, I'm not really that upset. If it does appreciate like it has in the past, that's great. I can 1031 exchange that and I can snowball that into more units very quickly. But when I plug in a $20,000 down payment, I want to receive 25% every year on that 20 grand, because my first goal has been to get to $10,000 a month in cash flow. Then when I get to $10,000 a month, I'm going to try and get to $20,000 a month. Excuse me. When I get to $20,000 a month, my goal is to get to $40,000 a month, and so on. That snowball will happen. But if my goal is to always look for appreciation as the primary target and look for value that way, I may not get the chance because those properties may negatively cash flow. I could easily buy $200,000 to $300,000 properties here in Maryland, but the maximum those would rent for are anywhere between $1,500 to $2,000 a month. They don't meet that 1% rule. I would lose money over time. And if a water heater goes out, I may lose 3 years cash flow. So I could be bankrupt before I even get the chance. That's why I invest in places where properties costs anywhere between $50,000 to $150,000. And if they're multifamilies or single families, they can rent for $1,200 to $2,000 a month, depending on the type of property. But they're going to far exceed that 1% rule. And if they go up at, appreciate at 3% year over year, great. If not, not the end of the world, because the cash flow is so high, it doesn't matter. That's my goal. My goal is cash flow. I want that to replace my current job. So that way, when I take a 2-week vacation, I don't have to stress about, losing out on making that 9 to 5 income. I can take a 2-week vacation knowing that I'm going to make that $10,000 a month from real estate, or I'm going to make that $20,000 a month from real estate. So your goal will point you in the direction of what market you want to achieve. And then something else I actually just thought about is the risk. The risk you're willing to accept may determine what market you choose. So for example, here in Maryland, I've heard stories of when people have had to evict their tenants don't leave. And so they've tied up the owner in their investment for 60 plus days, maybe even 6 months. And here in Maryland, it may take 6+ months to get somebody out. That ties up, again, if they're not paying, that ties you up. And you're stuck paying the mortgage. You're trying to get them out. It just doesn't benefit you. I invest in places where after 3 days of not paying rent, I can serve them with a 30-day notice to vacate. And if they don't vacate, I can kick them out within 14 days. If they don't, I file for eviction, and then maximum is going to be 30 to 45 days to get them out. And I've had to evict 2 people, and they were out within 30 days. So I lose 1 month's cash flow. Technically, I don't, because I keep their security deposit from evicting them, and I get the next person in there after turnover. And people say, like, how can you evict somebody? I've had that too. Like, do you ever feel bad about it? And the answer is no, because I've entered an agreement with that person. We've entered a written agreement that says you're going to pay me this money. We've done financial background checks. We've done all kinds of background checks. And if you don't pay, that's not my fault. I did not get into real estate to not make money. Now, I will give people chance to pay. My management companies will try to work with them, because ultimately I'm not out to ruin people's lives as well. But we entered a written agreement. If you don't abide by that agreement, you have to leave. It's as simple as that. So I hope you found this episode helpful. Sorry, I keep coughing. Oh. I hope you found this episode helpful about how that can help steer you in the right direction of what market to choose. And I will be seeing you next week for episode 7. And I appreciate you guys checking in. So all the best. Thanks. The advice and recommendations I offer are intended to be informative and educational, drawing from my own experiences in the real estate market. It is crucial to recognize that every investment decision carries risk and outcomes may vary. I am not a financial advisor, and the information provided during these podcast episodes is not intended as financial, legal, or professional advice. It is your responsibility to conduct thorough due diligence, seek the advice of qualified financial professionals, and make informed decisions based on your individual financial situation and goals.